Hello friends, I take the opportunity to wish all our online family members a glorious Vijay Dashmi, a happy Dasera, Durga Puja, and I hope this festive season brings you a lot of cheer, peace, fulfillment, joy, prosperity, and a whole lot of happiness. Friends, in my last week's video, we discussed what our strategy should be during war times, and we saw how scaling back exposure, waiting for bigger price moves like I've mentioned in this video, keeping Hacienda hedges or tail risk hedges like I've mentioned in that video, and basically playing a cautious hand would be a prudent thing to do, and that played out exactly that way. Now in this week's video, I want to discuss whether the retail guys, whether traders, bulls are in a mood or are capable as things stand today to take nifty highs to all-time highs on or before Diwali Muhurat trading. Now we'll take data as it comes, and we'll basically take a statistical approach which is completely unambiguous, data driven, and leaves no scope for guesstimates. Let's dive right in, and on your screen right now, weekly market outlook window, and as you can see, both the indices fell, with the bank nifty falling marginally more than the broad-based Nifty 50. The US dollar index, the Dixie, was up a little bit again, and it's now comfortably placed above the 102 mark, which has basically pressurized emerging markets, including India. The rising US dollar index failed to dampen the spirits of gold, which saw continued safe haven buying, though silver saw some amount of profit taking. Crude oil went up marginally based on fears of supply disruptions in the Middle East, and the Indian 10-year benchmark bond yields fell by 4 basis points. The USD INR, which is the United States dollar versus the Indian rupee, climbed up yet again, and it is now firmly placed above the 84 mark. The NSE market capitalization gained a little under 1/3 of a percentage point. That tells you that the buying was somewhat mildly but somewhat broad-based. MWPL, or market-wide position limits, rose routinely after expiry. We're going to come to that in a bit. And the US market indices went up and provided tailwinds to our markets and therefore cushioned the declines. Friends, I now come to the ratio chart of the Bank Nifty versus the Nifty 50, and as you can see, the index ratios did attempt to go up, which means the Bank Nifty attempted to gain vis-a-vis the Nifty 50 but failed. It's a hammer, a bearish hammer, which means even though the markets did show signs of nervousness in the banking space, at lower levels there were attempts to pull this sector higher. Now friends, you know me as somebody who believes in the cause and effect theory. Nothing happens in the market without a reason, and since these are financial markets, the reason is also financial. Remember, WYSIWYG, or what you see is what you get, does not exist in financial markets. Now, the reason why banking stocks are going up, in spite of the concerns that I have expressed on my free Telegram and WhatsApp channels, don't worry, our contact coordinates are there in the description below this video, and in the pinned comment below this video, and at the fag end of this video in a graphic format. So do join our free channels. You are not required to pay anything at all. So I've been expressing concerns over the interest rate sensitives, including banking space, and why are banking stocks still going up. The reason is here in this graphic. The simple thing is the weightage. Banking and financial sector stocks command a weightage of 1/3 of the entire Nifty. If you need the market to go up, you cannot manage to do that unless the banking and financial sector stocks go up, which is why this ratio is holding up. But if you want a sustained bull market where new highs are constantly being tested and reached, the Bank Nifty versus the Nifty 50 ratio has to climb above the 2.3, 2.35 mark and stay above that. Till then, I think you would basically see this kind of slight nervousness remain in the sentiments. Now, friends, I'll come to our in-house statistical indicators. I start with market-wide position limits. In this particular video, I have explained to you why this indicator is so very important. Now, as you can see the chart on your screen right now, the MWPL has risen routinely after dipping post expiry of the September derivatives series, but at 40.67. This is the lowest gain over the last three expiries. So after the expiry of May 2024, we've seen the market-wide position limits being higher than what it is at 40.67 a fortnight after expiry. That tells you that there was a little bit of hesitation in the bull camp to basically write out bigger checks. Do remember, when the prices are higher, you need to push even more to maintain the upward momentum. Friends, I now come to the stock and index futures turnover. This is three concurrent series, so it is October, November, and December. The spikes that you're seeing every 4 weeks, that is the expiry led spikes because of rollover. Turnover is recorded twice, and immediately after the expiring week, turnover comes down only to pick up slightly. Now, friends, I have something to draw your attention to. Last week, especially on Thursday and Friday, I noticed something that was very, very disturbing. And on that, one of the reasons is this reason which I am pointing out now, is what will depend whether the markets are able to notch up fresh lifetime highs on, before, or around Diwali, which is very, very shortly up ahead. You see, the turnover, which is the participation levels of the retail, HNI, institutional players, etc., fell very, very sharply. Where index futures turnover is concerned, I'm talking about in terms of number of lots traded, it was the lowest since 17th of September 2024. Not a problem. Not a problem at all. But stock futures turnover in number of lots traded was the lowest after 18th of March 2024. That is a problem. If at all bulls want to take the market higher, why would the turnover fall to almost 7-month lows? I'm not done yet. Now, you would say, Vijay, derivative prices do not impact the stock prices because the spot levels determine the derivative price and not the other way around. All right. So let me show you where the spot turnover has been. By spot, I mean the delivery segment. It was the lowest since 20th of March 2024. Thursday and Friday saw a steep, precipitous fall in the turnover in the spot segment. Now that is something I don't like. Now let's examine the possibilities. A, the festive season has started. People could be taking a break from trading. They could be traveling for their holidays. Fair enough. If that is the case, in the next 1 week, 10 days, if the turnover starts to pick up and the market also goes up, all is well and you're on track, on time for the possibility of a fresh all-time high. If not, there are enough other red flags which I will also point out. All right. So let's go back to the graphics. The next indicator that I will discuss is the advanced decline ratio. Now, in the week before last, the Nifty was down a very sharp, almost 4.5 percentage points. And the average advanced decline ratio during the week was 0.76. Advanced decline ratio has picked up, all right, to 1.61, which means for every 100 losers, there were 161 gainers. That's good, but the Nifty itself remains 0.20% lower compared to its prior week. So buying conviction, I would say, in the spot segment, in intraday traders or one Marshmallow traders, do take a look at the Marshmallow theory tutorials. The video link is below this video in the pinned comment and description below this video. So the one Marshmallow theory traders were basically showing higher risk appetite. Now friends, I come to the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Like the options premium, basis also erodes over time. It's a decaying asset. It also indicates the risk appetite. Higher is the premium, the more bulls are willing to pay to go long, even though the futures might see basis erosion over time. So, like I told you last week in my video, the elevated levels of 409 rupees for the Bank Nifty futures premium and almost 160 rupees on the Nifty 50 futures premium were unsustainable, and look what's happened. The Bank Nifty has just about a little short than 50% decline in basis, and the Nifty basis has also fallen a little more than 40-45% in basis. That tells you that risk appetite was lower. Do you want to see an all-time high? Then obviously turnover, which I pointed out was multi-month low, needs to pick up. MWPL needs to pick up. Basis needs to pick up. Now this is 3 consecutive mild but consecutive red flags. Now for the impetus, this is our in-house indicator. You've trusted for 4 years now, and it's basically stood the test of time. Since the last 2 consecutive weeks, both the indices have been falling. Admittedly, in the prior week, the falls were much bigger. Last week, the fall was smaller. But look at what's happened to the impetus. Now, impetus measures the force or the momentum of buying or selling. Whether it was a buying or selling momentum is determined by the price, and impetus measures the force. Since the last 2 weeks, both the indices have fallen and the impetus is now at a multi-month high. Obviously, somebody out there has been selling in a great deal of force. Another small red flag. Does it mean that an all-time high will not come? Hey, I'm not saying that, because for all you know, buying can suddenly pick up for XYZ reason, whatever. There could be hopes of a ceasefire in Gaza. There could be hopes of the cessation of war in Ukraine, or oil prices could come down, or there could be talks of mediation. Any number of factors can come in and trigger buying momentum back again. If that happens, then the worries might get lifted up above the shoulders of the market. But otherwise, this is another small red flag. Now I come to the lift weight thrust drag indicator. You've been trusting it for over 3.5 years now, and as you can see on the chart on your screen, the Nifty has basically reduced the amount of ground that is lost on a week-on-week basis to 0.20%, and the lift weight thrust drag indicator has gone up from 0.04 in the prior week to 0.21 last week. What it very simply means is that we are expecting the purchases or support at lower levels, which could be a little more proactive as compared to the prior week. Friends, the in-house indicators done. I now come to the bond markets, which you know I track very keenly, because this asset class market funds the price discovery mechanism of the other asset classes. Now, the Indian benchmark, 10-year benchmark bond yield has basically fallen last week. And what you can see is it attempted to rise, and then the candle chart tells you that there was a bearish piercing pattern where the bearish body of the latest candle is piercing the prior week's bullish body approximately halfway through. So there is resistance in the yields at higher levels. Now, what we need to watch out for are a combination of factors. Number one, the RBI has not changed the coupon rates, and they've basically changed their stand to neutral. The other thing that you need to note is the rupee dollar parity. We are now at the rupee is at a lifetime low against the dollar. And what we need to see is inflation going forward. That will determine how the Indian 10-year benchmark bond yields go. So the sum and substance of this is I'm still waiting in the wings. I'm keeping the powder dry and waiting for deploying money again in either the gilt funds or in the Indian 10-year sovereign bonds. I will update my plan of action on our free Telegram and WhatsApp channels as and when I decide to make my next move. Now, friends, I come to the Bank Nifty, and as you can see on the daily chart on your screen, this index rose on 2 out of 5 trading sessions, and it resulted in losses, weekly losses of 0.56%. Monday last week was a slam dunk decline, and it had a lasting impact on the weekly sentiments. The price is below its month-long moving average, which itself is headed downwards. The price is now firmly ensconced in its bullish wedge. So the short-term outlook appears to be somewhat nervous. Let's take a look at the weekly chart. What you are seeing is a bearish hammer. What it means is that even though the prices declined, bulls basically resisted any kind of a sustained down move and offered support at lower levels. However, the 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average bull, was pierced during the week. The price has, however, closed above it. So what we do need to watch out for is whether the 50,750 level, which is where the moving average is placed now, it will keep changing day to day, but ballpark 50,750 is what I would watch as a near-term support in the coming week. If the Bank Nifty starts to trade below it sustainably, you could see some more pressure. On the flip side, only a breakout above the all-time high will basically bring the bulls back in the driver's seat. Friends, do note what I have been telling you. This segment, the banking and financial sector segment, has a huge weightage in the Nifty, and unless this segment rises, you can't have a sustained bull market. So do watch this index, even though the Bank Nifty is not likely to be a weekly expiry index from November onwards, and the importance of this index does not reduce in any way. In the week before last, this index was number 2 on the most volatile counters list based on statistical beta rankings that we maintain in-house. It slipped 1 notch to number 3, so the challenge level went down marginally. Last week, I advocated an estimated range between 52,975 on the upside and 49,950 on the downside, which held perfectly well. In the coming week, I estimate a range between 52,700 on the upside and 49,650 on the downside. In addition to this range, please also monitor the daily, weekly, monthly pivots that I update on our free Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.20% on a week-on-week basis. And then the daily chart on your screen tells you this index basically fell on 4 out of 5 trading sessions. And like the Bank Nifty itself, the fall on Monday is what set the tone and tenor of the sentiments for the week that's gone by. The price, like the Bank Nifty itself on the daily chart, is below its month-long moving average, and the moving average itself is pointed downwards, so the short-term outlook is marginally nervous as of now. Turning to the weekly chart of the Nifty 50, what you are seeing is the smaller bearish candle compared to the gigantic bearish candle of the previous week. And it is also a hammer, which means bulls resisted a bigger decline during the week. They defended the 24,200 support level, which I had advocated last week, especially in my Live Mint column, which is India's first and only media column to offer statistical inputs to its readers. The price remains above its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost of an average investor, which means the medium-term outlook remains positive. And between the Bank Nifty and the Nifty 50, I would say the Nifty is relatively stronger compared to the Bank Nifty. Do remember, friends, what I have been telling you in the last few weeks. The price difference above its 25-week exponential average was so big that that opened up the possibility, the statistical probability of a correction or even consolidation. And that is precisely what is underway. Now, I would say that this moving average itself is likely to be a very nice, simple yet accurate support level to watch out for. It is currently poised at 24,250. It will change day to day, not much, but on the weekly chart, that's what I would want to watch out for in the coming week. Taking out the all-time high would be my first and foremost criteria to basically see that the market is headed into fresh lifetime highs. Friends, in the week before last, this index was number 8 on the most volatile counters list. It rose one notch to number 7. So the challenge level here actually went up. Last week, I advocated an estimated range between 25,625 on the upside and 24,400 on the downside, which held perfectly well. In the coming week, I estimate a range between 25,575 on the upside and 24,350 on the downside. In addition to these ranges, please also monitor daily, weekly, and monthly pivots that we update on our Telegram and WhatsApp channels. Friends, I now come to the last bit of statistical analysis wherein I monitor the footprint of the retail traders' risk appetite as borne out by the turnover contribution in the 4 segments in the F&O space. So the index futures turnover contribution went down by 5 basis points, indicated as a blue line. Stock futures turnover fell by 20 basis point, indicated as a red line. And what I surmise from this is the high volatility, high capital requirement futures space saw poor participation. Do remember, stock futures participation levels and turnover levels are the lowest after 18th of March 2024. This is not a great sign. Now, in the relatively safer options space, the only gainer in the F&O segment where turnover is concerned was the index options, which showed a turnover contribution increase of 60 basis points, whereas stock options turnover contribution fell by 35 basis points, indicated as a purple line. What does it tell you? Yes, the retail guys were bullish, but they were bullish in the least risky instrument of all, index options. So the risk appetite was clearly very small. Now, 2 Marshmallow traders, the Marshmallow theory videos in the hyperlink below, were clearly on the back foot. This is again another small red flag. Can it be overcome? Yes. But till it doesn't happen, I would sit and adopt a cautious stand. I'll continue to trade, but just like I said in my last week's weekly trading strategy, I'll basically keep my exposure levels lower. Now, friends, I come to my own weekly trading strategy. Like I mentioned, there will be not much of a change over the prior week. I will trade on low exposure and wait for bigger price moves as I've advocated in this video. I'll keep Hacienda hedges, which I've advocated in the tail risk hedge video. I'll remain focused on public sector undertakings like oil marketing companies, public sector banks, power, defense, logistics, and energy stocks, because these segments will give me bigger than average two-way moves. So risk savvy and risk experienced traders will get ample trading opportunities in the week ahead in these segments. I expect bullion to continue to get supported on all major declines, and the long-term story, the bullish story in bullion, remains intact. Please feel free to watch these 2 videos about the outlook on bullion and where to buy it at honest-to-God prices with purity intact. I remain on the theta decay bandwagon on the energy commodity space. Where industrial metals are concerned, I expect some amount of a slight pullback rally in the coming week, which will have a trickle-down effect on metal mining company share prices, which might go up a little bit. I will also continue to seek out theta decay opportunities in interest rate sensitives, which is banks, NBFCs, hugely leveraged bank loan leveraged companies, and those companies which are highly dependent on EMI based sales for their top line growth. Particularly since the RBI has kept the coupon rates constant, I think these stocks will basically provide good theta decay opportunities. If I need to share any more fresh ideas, as usual, they will be updated on our Telegram channel first and also the WhatsApp channel. Do connect with me there. My contact coordinates come at the fag end of this video. Friends, before I sign off, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up here. In the comment segment, do let me know how you find my videos and how I can help you better by recording videos on subjects that you recommend. Help me reach out to smart guys like yourselves by forwarding my videos to your friends, family, social media groups, etc. so I can help a larger number of traders take informed trading and investment decisions. I thank you for your patience in being with me in this video. I wish you have a very, very profitable week ahead. Take care. Bye-bye.